ULIPs or unit-linked insurance plans, they were a very popular investment option that investors considered around 2018 when the LTCG was introduced on equity investments, and that's because there was no equity taxation on these ULIPs. But does that advantage hold even now? Because there is a cap. Let's talk about this in a lot more detail and let's understand what you need to bear in mind. Arvind Rao, who is a CFP as well as chartered accountant and founder of Arvind Rao Associates, is joining me on the show. Arvind, good evening. Let me not try and introduce the topic further because I seem to be getting a little tongue-tied right now. Why don't you do it? What are ULIPs and how do they work?
So ULIPs, I think, were like a good bridge between what was built for insurance products, because traditionally insurance products have always been looked at from a long-term perspective. And given that fact, if it's typically traditional products, I think that's where the history of insurance goes, where it was mainly fixed income or guaranteed kind of products. And whenever you think long-term equities, I think is something that comes to everybody's mind. So ULIPs, I guess, were born from this necessity to have market-linked participation and investing in insurance. So basically, these are insurance plans where there is where whatever is the insurance part is deducted, and the rest of the amount from the premium is invested in markets. Or in different types of funds where one can participate in the upside over a longer period of time.
Okay, fair enough. So essentially you would talk about this as a combination of life cover as well as investment option. But there are various options within this, or is it that most people choose to go towards equity? But there's also a fixed income component that is possible, right?
Yeah, I mean, over time, what it has evolved in itself is that you have debt, you have sometimes even government securities can be as a fund choice, and then you have those balanced kind of things wherein it's part debt, part equity, and then you have full-on equity options as well available in this option. But I mean, and again, it depends on the investor's mindset at that point in time that they're doing it, because whether you like it or not, I think one fact is that there are a set of investors who are very comfortable in being in the debt space. So even if they were to enter into the ULIPs, I think they look out for options where they could be in the debt space. So it is for them that these options exist. One, or part B is whenever markets reach a high or they seem overvalued, when you are doing other investment products like, let's say, mutual funds or shares, there is always this concept of profit booking. So that's where this concept of debt also exists in ULIPs, where if you are participating in equities and you find that the valuations are stretched, you can always switch your units for the time being from equity to debt, maybe as a part of profit booking, and re-enter into equity whenever the markets are lower.
There was a major argument for ULIPs in 2018 after the introduction of LTCG on equity products. But that has gotten corrected. Could you very briefly tell us what the change was, I believe, in 2021?
So I think going back in history, 2018 is when the budget reintroduced the concept of long-term capital gains on equity mutual funds as well as equity shares. But somehow they kept this instrument, which is ULIPs, which also had equity participation, out of this gambit. And that's where between for the next 2 years, like 18 to 19 and 20, a lot of people flocked to ULIPs, because now here was one instrument which not only gave equity participation, but it also did not tax the proceeds of equity participation at the time of maturity. And hence in 2021, I think this, if I may so call, I may be wrong here, the anomaly got corrected when the budget introduced a tax on ULIPs, saying that as long as people are investing premiums which do not exceed 2.5 lakh rupees per annum for ULIPs, anytime after 1st of Feb 21, the maturity proceeds on ULIPs would be taxable. So in other words, all premium contributions to ULIPs up to 2.5 lakh of rupees per annum is still out of the purview of tax, and anything above that will be taxed at 10%. So as the budget was reinforced into law, what it has evolved is whatever is the difference between the maturity proceeds and the total premiums that a person has paid, that difference will be counted as let's say a quasi capital gain, and on which the investor is required to pay tax at 10%.
Let's talk about then the current context. Which types of individuals then should consider, if at all, investing in ULIPs? Because let's be clear, these are not essentially insurance products. They also happen to give you a life cover. They're essentially investment products.
Well, that's one way to look at it. But I mean, I've had some, and I generally I use this example because whenever we generally tell people that it's better to keep insurance and investments separate, and I think that's what traditional wisdom says. But we've had people who say that the fact that instruments like mutual funds or equity shares are liquid and can be redeemed at any point in time sometimes acts as a barrier or a disadvantage to certain set of investors, because they say that because there is no lock-in, I am tempted to use these investments for any other kind of, if we can so call it, distractions that come in my life, which requires money. And that's where insurance products, and especially if you want equity participation, then ULIPs, they come into picture here, because typically people tend to view insurance as locked-in products, although the prescribed lock-in is only 5 years for any kind of insurance products. And after that, you can surrender it if it required. But somehow people's mindset is with insurance that whatever is the term prescribed in the policy, that's where they will hold it for. So in my view, people who still want to get into ULIPs, keeping the 2.5 lakh threshold in mind, will be these kind of people who prefer to invest in insurance. And like you rightly said, yes, insurance is available. But today, I think there is a lot of awareness and literacy among people that 5, 10, 15 lakh of coverage, life coverage is not sufficient for a person. And people generally tend to go for 50 lakhs and above as a term coverage. So for that, ULIPs are not the perfect vehicle, because you will get 10 times the annual premium as your cover. So you need to shell out more premium to get more cover. So So ULIPs today fit well into the perspective of people who are looking to start small investments and lock it in for a longer time.
I very quickly want to talk about another product which seems to be gaining popularity, and this is in the fixed income space, as I understand it, guaranteed products. I mean, they're called by different names, but I think the guaranteed product is one of the features in the name. Could you explain how these work very quickly?
And in the same breath, I think, Alex, let me add here that somewhere we have seen that these products have started gaining more popularity among larger investors in the last 1 year after this 2.5 lakh limit came in for ULIPs. Now, typically, they go by different names, but I think the way these plans operate is that for the first, there's a premium payment period which is defined, which could be somewhere like 7 years, 8 years. It can go up to 12 years. After that, there is a payout period, which could be starting from the year 13, it could go right up to year 30, in which a fixed amount is paid to these policy holders. And at the end of the 30th year, a lump sum, which is typically called the maturity benefit, is paid out to the policy holder. Now, in a nutshell, I mean, while absolute numbers may show a different picture, but in reality, the IRR, or the internal rate of return on these products, is hovering, I mean, in my view, whichever illustrations I have seen and I've tried to decode it, it ranges somewhere from 5.2% to around 6% across different companies. Now, Alex, the good part about this product, these guaranteed products are, one, of course, as the name goes, these payouts are guaranteed. Number two, these payouts are called as survival benefits. Hence, what happens is these, although I think when people must have heard this, it sounds like an annuity, a quasi annuity coming to an investor. So these annuities being in the nature of survival benefits being paid out by a life insurance policy, these proceeds are not taxable. So this IRR of 5.2 or 6% that I'm mentioning turns out to be a tax-free kind of a return for these investors. So people in the debt space or in the fixed income space who are looking to get a guaranteed kind of a return and a 6% IRR tax-free, Alex, is something that is not easily available today. So locking in a 6% IRR for the next 20 or 25 years is quite a value proposition, especially for people in the 35 to 40% tax bracket, because I'm sorry, because something like this is not available in the alternate debt space.
You know, I think that's an interesting proposition and certainly something to consider. We will speak about this, Arvind, in more detail, I'm sure, at a later date. But I think we've given people a fair idea of how ULIPs work and how these fixed income products work. Thank you so much for taking the time.
Sure, Alex. Thanks for having me here. Bye-bye.